Good morning, I'm Harley Schlanger from the LaRouche organization with your daily video update for April 3rd, 2023. As I've been reporting recently, we're moving into a time where one of the key words you hear internationally is de-dollarization. The fact that much of the world has concluded that you cannot trust the dollar, cannot trust the United States and the City of London, and therefore you need alternative arrangements, including using national currencies and regional blocks for trade and investment. Now, there's more news of de-dollarization from just the last couple of days. We have seen the efforts by the Chinese to work to bring the yuan into the basis of trading with countries such as Saudi Arabia, the United Arab Emirates, and so on. The latest of these agreements is between Brazil and China, an agreement to settle trade in yuan. Now, what this means is that they're also going to use the yuan as a credit and lending currency in Brazil. Now, this is happening simultaneous to a big sell-off of dollar assets, particularly U.S. Treasuries. Brazil, for example, in 2022, sold off a total of $22 billion of U.S. Treasuries. Now, in March of this year, that is just last month, they sold off 21 billion more, so almost as much in 1 month as they had the year before. China in 2022 sold 175 billion of U.S. Treasuries. And the Bank of Japan, which is supposedly a U.S. ally, sold off 189 billion of its Treasury holdings in 2022. And Russia, meanwhile, now has 30% of its central bank reserves in yuan. Now, why is this happening? Well, there's several reasons, but the two most important, one is the seizure of assets by U.S. banks from Afghanistan of $9 billion and from Russia of $300 billion, shows that that holding your money in U.S. dollars in U.S. banks is no longer safe. There's a lack of trust, and without trust, there is no monetary system. But secondly, it's the long-term effects of quantitative easing. The fact that treasuries no longer are a safe place to put your savings or to draw credit. And this has become a central feature of a highly volatile trading system in which instead of long-term thinking, it's hour to hour and sometimes minute-to-minute casino-type decisions that shape the investment policies of nations. Now, in the U.S., we're having a credit crunch. We're seeing a contraction of physical economic production and accelerating deindustrialization. The dollar is falling. It's down 8% in the last 5 months. And a top analyst at Hong Shang Bank says that this will continue for at least 6 months. Now, to look at some of the commentary on this, there was a relatively insightful article posted by Nouriel Roubini, who sometimes goes by the name of Dr. Doom. Ironically, the title of his article is The Coming Doom Loop. And he starts by saying that only a severe recession will stop inflation. And he said this will make the debt crisis worse and will lead to what he described as the mother of all economic crises. And his conclusion is there is nothing policymakers can do about it. In other words, if you want to stop inflation, you have to go through a recession, and this will have, at this point, unforeseen consequences that could lead to a total collapse. Now, this is where he's wrong, because his approach is that of a traditional monetarist, an economist who sees the role of money as the essential feature of what determines economic health and stability. He ignores the real cause of the crisis, which is what Lyndon LaRouche pointed to in his famous 2007 warning of a banking collapse that's coming because of the mortgage-backed securities business. He ignores the fact that it's a collapse of productivity growth, not bad investment decisions, but productivity growth falling, that's the cause of the economic crisis. Now, the driver of an economy is the rate of scientific and technological innovation that is then introduced into the physical economic processes, in particular into the machine tool production. And this defines the ability of capital goods sector to survive and thrive. This has collapsed. There's an extremely low level of productivity gain based on scientific and technological progress. And so the ability of firms to service their debt, which they used to do based on the profit made from scientific and technological advance, it means that instead, to maintain debt payments, they have to borrow increasingly. And secondly, invest in increasingly risky financial instruments to try and make short-term profit to cover their debts. These are what are known as zombie corporations. They don't make enough profit to cover the interest on their debt. And now with interest rates going up, we're reaching a point of absolute unsustainability in the debt system, a debt bubble that's going to pop. Now, what Rubini doesn't consider is the starting point of Lyndon LaRouche's approach, which is that you can't continue this system. You need a restructuring. And the restructuring includes traditional bankruptcy methods. That is, if a firm has no way of making its way out of the debt crisis, you write off the debt or write down the debt significantly. And then you need, if it's a company that can still make a profit, then you need a new flow of credit. But you have to change the method of approach. And the money has to go into tangible capital goods production. That is, real physical goods production, infrastructure investment. That's what's needed, because you need to produce net increases in wealth, but not wealth in dollar terms or money, but wealth in the physical ability to transform an economy. Now, my colleague Paul Gallagher pointed out in a recent report that this was the approach that was taken from the 1930s to the 1960s. That is, a constant investment in technological progress. And the idea that productivity growth is what drives economic stability and growth, as opposed to savvy investment and finding the quickest approach to make a quick buck. What Paul reported is that annual levels of labor productivity growth from the 30s to the 60s were almost 3% per year. And this produced the surplus needed to not only cover old debt, but to take on new credit to develop new approaches with research and development, new plant and equipment, expanded workforce, and so on. Now, instead, today, while productivity growth has fallen, low interest rates have provided funds for speculation. And so you have more and more risky investments driving up the total debt, and with almost nothing backing it up. So the problem we have is that Western thinking is trapped in monetarist ideology. And this is the role of the central banks, the so-called financial media, and investment counselors, and so on. And so while this is happening in the West, the rest of the world is moving toward a new system based on the ideas that come from what we saw in the West in the 1930s to the 1960s. Just as an example of this, there was a conference on India-Russian partnership that announced a plan for a new currency to be presented at the BRICS summit in August of this year that will take place in South Africa. What they're talking about is becoming less dependent on the dollar, or total de-dollarization, and establishing a transition to use of national currencies for trade and investment. Now, Lyndon LaRouche wrote a paper on this process back in July 2000, titled "On a Basket of Hard Commodities." I'm going to append on the description section of this update a link to that paper. I would urge you to read it and think about it before you fall into the state of mind that's introduced by Dr. Doom in his article, which is largely the result of his adherence to this proven policy of monetary economics, which has proven to be a failure. So thanks for joining me today. See you again tomorrow. Hello, thanks for watching. Be sure to like, subscribe, and hit the notification bell so you don't miss any of our videos. Support our independence to produce videos like these. Become a member of the LaRouche organization at thelarouche.org/member. By becoming a member for $25 or more, you'll get special access to the EIR Alert Daily Briefing and weekly magazine, which is what I read to stay on top of things.